Hey everyone, welcome back to the channel. Today we're diving into a bold statement from one of Wall Street's most well-known bulls, Tom Lee, co-founder and head of research at Fundstrat. In a recent appearance on CNBC's Closing Bell, Tom said something that really stood out. Investors shouldn't fear this rally, they should fear missing out. Now that's a powerful take. While most investors are still on the sidelines, doubting the market's strength or waiting for the next pullback, Tom Lee believes this market has a lot more room to run, and he's not alone. Joining him in the discussion are 𝗗𝗏𝗦𝗧 from 𝗑𝗟𝗨𝗦 and Chris Harvey from Wells Fargo, both bringing their own insights on where the market stands today. In just a moment, I'm going to show you the full clip of Tom Lee's CNBC appearance, unfiltered. After that, I'll break it all down and give you my personal reaction to what he said, what it means for your portfolio, and what you should be watching out for in the weeks ahead. And stick around till the end, because I'll also be revealing 3 breakout growth stocks you should consider adding to your watch list right now, especially if Tom Lee's outlook proves to be correct. So, if you're serious about making smarter investing decisions, this is the video to watch today. Before we jump into the clip, do me a quick favor. Smash that like button. Let's get this video to 1,000 likes. Drop your thoughts in the comments. Do you agree with Tom Lee? And make sure you subscribe so you don't miss my next big investing update. This video is sponsored by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Alright, let's hear what Tom Lee has to say.
Let's bring in Fundstrat's Tom Lee, New Edge Wealth's 𝗗𝗏𝗦𝗧, and Wells Fargo's Chris Harvey. Tom's a CNBC contributor. It's great to have everybody on the set here. Those are your words. You continue to say that this is the most hated V-shaped rally. Is it still?
Yes. Markets made new highs this week. I don't find a lot of people cheering and happy. Most of our institutional clients are skeptical of this recovery because they feel that there's still looming uncertainties, whether it's the FOMC or the tariff deadline. So, as you know, markets don't peak when investors are skeptical. They peak when there's over-exuberant enthusiasm. There's no signs of that today.
They're not wrong with wondering about the uncertainty relative to those issues, are they?
They're not wrong, but I think it's the amplitude that people got wrong. So in April, people thought if you didn't have a trade deal, we'd have economic Armageddon. But now what they're finding that is if you're wrong, it's just we don't have to fall off a cliff. And so there can be diplomatic solutions or even pushing off deadlines.
Okay. Chris Harvey, survey says. Is he right?
I wouldn't call it the most hated bull market, but I would say a lot of people are looking for a pullback. They're talking about things being overextended. They're talking about uncertainty with the Fed and earnings and lions and tigers and bears don't know. I don't know what the short term holds. I think we could see a consolidation. It's really unclear for me, but the underlying fundamentals still strong. We do think the Fed will certainly have to be dovish in the next couple of months. And what we also think is that rates are going to rally because the deficit, in all likelihood, while not going to be good, will probably be better than expected based on some of the tariff news that we're getting.
I mean, this guy is known for being like one of the most bullish people around.
Yeah.
You've been right there riding shotgun with Tom Lee the whole time.
Yeah. I think we were on the show and we were talking about 5,000 being the bottom. Uncertainty was overblown, and this was a time to get more bullish, and the AI trade was one way to do it. We're still there, and we've been talking about how does the AI trade break, how does it pull back. We've been looking at a lot of different things, and one thing I think that's could potentially hurt the AI trade is if you do get the Fed cutting, if growth is better than expected, if rates do come down, suddenly the contrarian trade starts to look better, and you could see a rotation. And I think that's the biggest fear for AI right now.
Okay, bullish. Ms. Dawson.
Decisively neutral and optimistic. So we don't want to fight this trend. The trend is powerfully up. That doesn't mean we can ignore risk. So definitely agree with both Chris and Tom that you're at a point where this is not a market that is way overweight. You still are just in the 44th percentile in positioning. There's still cash on the sidelines to get pulled in. But we have to note that a lot of the things that have led the rally higher coming out of the April low have been the lowest quality parts of the market. You've seen things like speculative, non-profitable tech up nearly 100%. You've had huge runs in areas that show that there's a lot of speculative fervor that's starting to bubble up. We don't think that that is enough yet to kill the rally whatsoever, but we do think that it sets you up potentially for a little bit of digestion, mostly as we get into this seasonal period in August where typically volatility picks up. So nothing cataclysmic.
I'm glad you brought that up because I wanted to bring that up myself, but you teed it up for me. Goldman's Global Investment Research Team was out with a report today on that very topic. Our speculative trading indicator has increased sharply during the last few months. It now sits at its highest level on record, outside of 98 to 01 and 2020 to 2021. It signals near-term upside risk for the broad equity market. It also increases the risk of an eventual downturn. During the last 35 years, other sharp increases in speculative trading activity have signaled above-average subsequent 3, 6, and 12-month returns, but returns typically faltered on a 24-month horizon. So they're talking about the speculative stuff you're talking about, so-called low-quality stocks, high beta stocks that are going up. Makes you nervous?
So Bob Farrell, who's a legendary strategist from Merrill Lynch, always used to say that parabolic moves go further and last longer than you think, but they never correct by going sideways. So it means that we could still see this run, but would note that high beta is in the 100th percentile. Means that that kind of performance has not gotten better than this. You've seen a surge in call option volume, which just shows that people are only thinking about upside. So it's certainly a potential risk. You saw FINRA margin loan balances up almost 20% in the last 2 months. So people are taking on more leverage. This is clearly signs that people want leverage to the upside and they're not necessarily thinking about the downside.
So the core of the interview, the very first thing they brought up, was this idea that the market has been on a massive rally since the April lows, but somehow it still isn't getting much love, and Tom Lee calls it the most hated V-shaped rally. Now why would a strong, high-performing rally be hated? That's the key question. According to Tom Lee, the rally isn't being celebrated because most institutional investors, the big money, are still extremely skeptical. And when you dig into that, it's not hard to see why. There's lingering fear around major issues like Fed policy decisions and trade deadlines. But what Tom is pointing out is super important. Markets don't typically peak when people are cautious. They peak when everyone is overly excited and euphoric. Right now, we're not there yet. In fact, we're far from it. Tom's basically saying, look, this skepticism is actually a good thing for the rally. Because it means there's still room for growth, still fuel left in the tank. If everyone was already all in and overly bullish, then yeah, that would be a warning sign. But we're not at that stage yet. Then, he makes an important point about the scale, or as he calls it, the amplitude, of the fear. Back in April, if you remember, the sentiment was that if we didn't get a trade deal, the economy would collapse. It was full-blown economic Armageddon fears. But fast forward to now, and what actually happened? No collapse. Instead, we've seen diplomatic progress and deadline extensions. Things didn't fall apart. That mismatch between fear and reality is what helped fuel the rally. Investors were too bearish, and they got caught on the wrong side. Chris Harvey from Wells Fargo jumps in next, and he takes a slightly more cautious stance. He doesn't necessarily call it the most hated rally, but he does agree that people are waiting for a pullback. Everyone's talking about things being overextended. And let's be honest, you've probably heard that too from analysts or in social media circles. Oh, the market's gone up too much, too fast. Chris says the fundamentals are still strong and that the Fed will likely stay dovish, meaning they'll support growth rather than tightening policy aggressively. He even believes that interest rates may come down, especially if the deficit and tariff situation improves. So, while he's cautious about the short term, he's not bearish on the broader outlook. Then we get into a topic I know a lot of you are interested in. AI stocks. Now here's where it gets really interesting. Tom and Chris have been bullish on the AI trade, and they've been on that train for a while, even when others doubted it. But now they're wondering what could derail it. And one risk? Ironically, if the economy gets too strong, if growth beats expectations and the Fed cuts rates, the market could start rotating out of AI and into other sectors, like value or cyclical names. That would mean less momentum for AI stocks, even though the market overall could still rise. This is what we call a rotation risk. It's not that AI becomes bad, it's that investors might look for better risk-reward elsewhere. Then, Cameron Dawson steps in with what I think is probably the most balanced view of the whole panel. She says she's decisively neutral, but optimistic, and honestly, that's where a lot of smart money sits right now. She acknowledges the rally is strong, powerfully up, as she says, but she also cautions that we're starting to see signs of speculative behavior. Specifically, she calls out the lowest quality parts of the market leading the rally. Things like non-profitable tech stocks, high beta names and speculative plays up almost 100%. That kind of froth doesn't typically last forever. In her words, this isn't enough to kill the rally yet, but it does set us up for a period of digestion. Think of it like this. After eating a huge meal, even a healthy body needs to rest and digest. Same thing here. The market may pause, consolidate, or pull back slightly before continuing upward. At this point, the conversation takes a more cautionary tone. They bring up a report from Goldman Sachs about rising speculative trading activity. Goldman's indicator is now at its highest level in decades, only previously matched during the dot-com bubble and the pandemic stimulus rally. Now that's big. And while Goldman points out that historically this level of speculation often leads to strong 3, 6, and 12-month returns, it also usually ends badly over a 24-month horizon. That's a classic boom-then-bust pattern. Cameron echoes this. She says, yeah, parabolic moves can go on longer than you think, but they don't correct by going sideways. Translation, if there's a correction coming, it probably won't be soft or gradual, it'll be sharp and sudden. She also notes that call option volume is exploding and FINRA margin balances are up nearly 20% in just 2 months. That tells us people are using leverage, debt, to chase the rally. And when people start leveraging up and betting only on upside, that's when things get fragile. So, to wrap this all up, what do I personally take away from this interview? Tom Lee is telling us not to fear this rally. It's hated, yes, but that's exactly why it still has legs. Institutional skepticism is actually fuel for further upside. And while there are short-term risks, particularly with speculative froth building up in low-quality stocks, the fundamentals remain solid. But the warning signs are flashing too. Margin debt, overbought speculative names, and crowded AI trades could set us up for rotation or even a sharper correction down the line. So, this isn't the time to be blindly bullish, but it's also not the time to fight the trend either. This rally might not be loved, but it's still alive. Stay cautious, stay diversified, and most of all, stay informed. That's it for this breakdown, guys. If you found this video helpful, make sure to hit that like button, subscribe if you haven't already, and let me know in the comments what you think about Tom Lee's take. Are we in the middle of a healthy bull run, or are we flying too close to the sun? Now let's dive into the 3 growth stocks you should consider adding to your watch list right now. Our first pick is Meta Platforms, ticker symbol Meta. Yes, the company behind Facebook, Instagram, WhatsApp, and Messenger. But Meta is so much more than just a collection of popular apps. It's a technology powerhouse that has fundamentally changed the way billions of people connect, communicate, and share their lives every single day. With nearly 4 billion monthly users across its platforms, Meta's advertising reach is truly unmatched. This vast audience gives Meta a unique advantage, allowing it to generate massive, resilient revenue streams that have proven durable even in challenging economic times. Advertisers flock to Meta because of its scale, targeting precision, and the sheer amount of time users spend on its apps. But Meta isn't just about social media anymore. Mark Zuckerberg's bold pivot to the metaverse signals a visionary bet on what could be the next evolution of the internet. The company is investing billions into virtual and augmented reality, aiming to build immersive digital worlds where people can work, play, and interact in entirely new ways. This is a long-term play, but it's one that could redefine how we experience the digital world. While Reality Labs spending has scared off some investors, it's important to remember that these investments are funded by a cash-rich core business. Meta's social media empire continues to throw off enormous amounts of cash, giving the company the flexibility to invest aggressively in future technologies without jeopardizing its financial health. Meta's leadership in artificial intelligence is another game-changer. Their platforms use advanced AI for ad targeting, content recommendations, and even moderation, making them more engaging and profitable. AI helps Meta deliver the right content to the right person at the right time, keeping users hooked and advertisers happy. Now, Meta is integrating generative AI across its apps. Think AI chatbots in Messenger that can answer questions or help with shopping, and image tools on Instagram that let users create and edit content in ways that were impossible just a few years ago. These innovations boost user engagement and create new value for creators, influencers, and businesses of all sizes. The market once punished Meta for its future-focused investments, but with a renewed focus on efficiency, margins are improving and free cash flow is surging. The company has streamlined operations, cut unnecessary costs, and is now reaping the rewards of a leaner, more focused business model. They're even paying dividends and buying back shares, a strong signal of management's confidence in the company's future. These shareholder-friendly moves are rare for a tech giant and show that Meta is committed to rewarding investors while still investing in growth. Meta's moat is nearly unbreakable. The network effect keeps users locked in, as friends, family, and communities are all on the same platforms. Competitors simply can't catch up to the scale and engagement Meta has built over the past 2 decades. You're not just buying a social media company, You're investing in a leader in digital communication, artificial intelligence, and the future of online interaction. Meta's platforms are where people gather, share, and do business, making it an essential part of the digital economy. Meta's resilience is proven. They've faced intense scrutiny, regulatory challenges, and fierce competition, yet always come out stronger. The company has adapted to changing rules, shifting user preferences, and new technologies, demonstrating an ability to evolve that few companies can match. The Reality Labs investment is like a venture bet within a blue-chip company, giving you exposure to world-changing tech without the risk of betting on a tiny startup. If the metaverse vision pays off, Meta could be at the center of a new trillion-dollar industry. Even if the metaverse takes time to materialize, Meta's advancements in AI and augmented reality will continue to boost its existing platforms and open up entirely new revenue streams. The company is already rolling out AR features and AI-powered tools that enhance user experience and keep Meta ahead of the curve. Their international growth story is just beginning. With billions of people in emerging markets still to reach, Meta has a massive runway for user growth and new monetization opportunities. As internet access expands globally, Meta's platforms are often the first stop for new users coming online. Meta's free cash flow funds not just R&D and acquisitions, but also shareholder returns, making them flexible and future-proof. This financial strength allows Meta to weather downturns, invest in innovation, and seize new opportunities as they arise. Their proprietary data is a unique asset, fueling AI, driving better ad targeting, and creating a competitive edge that's nearly impossible to replicate. This data advantage is a key reason why Meta's platforms remain so effective for advertisers and so sticky for users. In short, Meta is a misunderstood growth stock, blending stability, relentless innovation, and long-term upside. It's a rare combination that makes Meta stand out in a crowded tech landscape. Don't overlook Meta. It's not just your grandma's Facebook anymore. Today, it's a global platform that connects generations, cultures, and businesses, constantly evolving to stay relevant and indispensable. The company's blend of scale, cash flow, and vision makes it a must-watch for the next decade. Meta is positioning itself to lead not just in social media but in the next wave of digital transformation. With a market cap of $1.8 trillion, Meta is showing no signs of slowing down. In 2024, the company generated an impressive $164.5 billion in revenue, resulting in a net income of $62.36 billion. That translates to earnings per share of $26.32 and a price-to-earnings ratio of 27.08. These numbers reflect a company that's not only highly profitable but still growing aggressively, especially as it doubles down on AI and the metaverse, while maintaining its dominance across platforms like Facebook, Instagram, and WhatsApp. If you want a stock that can weather storms, adapt to change, and lead the next wave of tech innovation, Meta deserves a spot in your portfolio. Its resilience and adaptability are second to none. The year of efficiency has reignited investor confidence, and Meta's relentless innovation keeps it ahead of the curve. Every year, the company finds new ways to grow, improve, and surprise the market. This is a growth engine hiding in plain sight, quietly powering the digital world and shaping the future of technology. That's why Meta is our first must-own growth stock. For investors seeking a blend of innovation, stability, and long-term potential, Meta stands out as a clear leader for the years ahead. Our second pick is Taiwan Semiconductor Manufacturing Company, TSMC, ticker TSM, the world's leading semiconductor foundry. While you may not see their name on your favorite devices, TSMC is the silent force behind nearly every piece of advanced technology you use today. From the smartphone in your pocket, to the servers powering the internet, TSMC's chips are everywhere, quietly enabling the digital age. TSMC manufactures chips for giants like Apple, Nvidia, and AMD, holding over 60% of the global foundry market and over 90% for the most advanced chips. Their client list reads like a who's who of the tech world, and their chips are the brains behind everything from high-end graphics cards to the latest iPhones. Without TSMC, the pace of innovation in consumer electronics, cloud computing, and artificial intelligence would grind to a halt. Their technological lead is a fortress, decades ahead of competitors, with expertise and scale that can't be matched. TSMC's relentless focus on research and development has allowed them to consistently shrink transistor sizes, pushing the boundaries of what's possible in chip design. This edge isn't just about being first, it's about being so far ahead that others can't catch up. As AI, 5G, electric vehicles, and the Internet of Things explode, TSMC is the essential toll booth for the digital future. Every new wave of technology, whether it's self-driving cars, smart homes, or next-generation wireless networks, relies on TSMC's ability to deliver ever more powerful and efficient chips. Their foundries are the launchpads for tomorrow's breakthroughs. Every major tech company relies on TSMC's advanced manufacturing, giving them immense pricing power and sticky customer relationships. Once a company starts working with TSMC, switching to another foundry is almost impossible due to the complexity and precision required. This creates a moat that protects TSMC from competition and ensures a steady stream of business. Their financials are stellar: strong revenue growth, high margins, and a growing dividend. TSMC's consistent profitability allows them to reinvest billions into new technologies and facilities, while also rewarding shareholders. Their balance sheet is a testament to operational excellence and disciplined management. Geopolitical risks exist, but TSMC is diversifying with new fabs in the US, Japan, and Germany, reducing concentration risk. By expanding globally, TSMC is not only protecting itself from regional instability, but also strengthening relationships with governments and customers worldwide. This global footprint is becoming increasingly important as nations recognize the strategic value of semiconductor manufacturing. The world's dependence on TSMC creates a silicon shield. Global stability depends on their chips. In many ways, TSMC is a linchpin of the modern economy, and its continued operation is in the interest of countries and corporations alike. This unique position gives TSMC leverage and influence far beyond its size. TSMC's relentless R&D keeps them at the cutting edge, shrinking transistors and improving efficiency year after year. Their engineers are constantly pushing the limits of physics, finding new ways to pack more power into smaller spaces. This commitment to innovation ensures that TSMC remains the partner of choice for the world's most ambitious tech companies. Their scale brings cost advantages, reinforcing their dominance and enabling further innovation. With massive production volumes, TSMC can invest in the most advanced equipment and processes, driving down costs and increasing efficiency. This virtuous cycle makes it even harder for competitors to catch up. As more companies design custom chips, TSMC becomes the default manufacturing partner, benefiting from every new tech trend. Whether it's a startup building the next big AI chip or a global giant launching a new product line, TSMC is at the center of the action, capturing value from every corner of the industry. Government incentives like the U.S. CHIPS Act help TSMC expand globally while de-risking operations. These policies not only provide financial support but also signal the importance of TSMC's role in national security and economic growth. As governments compete to attract semiconductor investment, TSMC stands to benefit from a wave of public and private support. TSMC is a picks and shovels play, profiting from the entire tech sector's growth, not just one winner. No matter which company leads in AI, smartphones, or cloud computing, TSMC wins as the essential supplier to them all. This broad exposure makes TSMC a resilient and attractive investment. Their deep partnerships with customers like Apple create high switching costs and long-term contracts. These relationships are built on trust, technical collaboration, and years of shared success. For customers, moving away from TSMC would mean risking delays, higher costs, and potential setbacks in innovation. Despite geopolitical headlines, TSMC's valuation remains attractive for long-term investors. The company's fundamentals are strong, and its growth prospects are tied to the unstoppable rise of technology in every aspect of life. For those willing to look past short-term noise, TSMC offers a compelling opportunity. This is a quiet powerhouse, essential to modern life, yet often overlooked. While other tech companies grab headlines, TSMC works behind the scenes, making sure the world's devices run smoothly and efficiently. Their impact is felt everywhere, even if their name isn't always in the spotlight. If you want broad exposure to innovation, TSMC is a foundational holding. It's a way to invest in the future of technology without having to pick individual winners. TSMC's reach spans industries, continents, and technologies, making it a cornerstone for any forward-looking portfolio. The demand for advanced chips will only grow, and TSMC is the only company delivering at scale and quality. As the world becomes more digital, the need for faster, smaller, and more efficient chips will accelerate. TSMC's ability to meet this demand is unmatched, ensuring its relevance for decades to come. Don't let complexity or headlines scare you away. The opportunity is massive. The semiconductor industry may seem daunting, but TSMC's track record, leadership, and strategic vision make it a rare gem in the investment world. For those who understand its importance, the potential rewards are significant. TSMC is indispensable to the global economy and the tech revolution. Every major leap in computing, connectivity, and automation depends on their chips. As technology continues to reshape our world, TSMC's role will only become more critical. With a market cap of $1.27 trillion, it's the unseen giant powering much of the tech world. In 2024 alone, the company pulled in revenue of 2.89 trillion Taiwanese dollars, with a net income of 1.17 trillion TWD. That brings its earnings per share to 50.50 TWD, and its price-to-earnings ratio to 22.67. For a company operating at the heart of the global semiconductor supply chain, these figures underscore just how critical and stable TSMC remains in a world increasingly dependent on high-performance chips. For investors seeking growth, stability, and a stake in the future, TSMC is a must-own. It's a company that combines world-class innovation with financial strength and global influence, a rare combination in today's market. This is the ultimate behind-the-scenes growth stock. While others chase the next big thing, TSMC quietly powers the entire ecosystem, making it an anchor for any technology-focused investment strategy. TSMC's dominance is unmatched, and that's why it's our second pick. Its combination of scale, innovation, and strategic importance makes it a company that's not just leading today, but shaping the future. The world runs on chips, and TSMC makes them all. As technology becomes ever more central to our lives, TSMC's influence will only grow, making it a true unseen giant powering our world. Our third pick is Netflix, ticker NFLX, the streaming pioneer and global entertainment powerhouse. Few companies have transformed how we consume media quite like Netflix. What started as a humble DVD rental service has become a cultural force, shaping the very definition of home entertainment for millions around the globe. Netflix's journey from mailing DVDs to dominating streaming is legendary. They built a brand synonymous with online entertainment. In the early 2000s, Netflix disrupted the video rental industry, making it easier and more convenient for people to watch movies at home. Their bold pivot to streaming in 2007 was a game-changer, setting the stage for the binge-watching era, and forever altering how we discover and enjoy content. Despite fierce competition, Netflix remains the anchor of streaming, with over 270 million paid subscribers worldwide. Its platform is accessible on nearly every device imaginable, from smart TVs to smartphones, making it a truly global service. Netflix's reach extends to over 190 countries, and its content is available in dozens of languages, ensuring that almost anyone anywhere can find something to watch. Their scale lets them outspend rivals on content, creating a self-reinforcing flywheel. More subscribers fund better content, which attracts even more users. This virtuous cycle has allowed Netflix to invest billions in original programming, from blockbuster movies to acclaimed series, and to secure exclusive deals with top creators and talent. Netflix's focus is singular: no legacy businesses, just streaming excellence. Unlike traditional media companies juggling cable networks or movie studios, Netflix is all in on digital, allowing them to innovate rapidly and stay ahead of shifting consumer habits. Recent moves like cracking down on password sharing and launching an ad-supported tier have reignited growth and profitability. By encouraging more households to pay for their own accounts and offering a lower-priced, ad-supported option, Netflix is reaching new audiences and unlocking fresh revenue streams. The ad business is just beginning, but with Netflix's massive engaged audience, the potential is huge. Advertisers are eager to reach Netflix's global user base, and the company's data-driven approach could make its ad platform one of the most effective in the industry. Now, Netflix has two engines: subscriber growth and high-margin advertising. This dual approach not only diversifies revenue but also provides resilience against market shifts, making Netflix's business model more robust than ever. Their global reach is unmatched, producing local content that becomes worldwide hits. Think Squid Game and Money Heist. Netflix invests heavily in regional productions, giving local creators a platform and bringing diverse stories to a global audience. This strategy has paid off, with international originals often topping charts and sparking cultural phenomena. International expansion is far from over, with huge markets in Asia, Africa, and Latin America still to capture. As internet access grows and streaming becomes more affordable, Netflix is poised to add millions of new subscribers from these regions, further cementing its global dominance. As competitors pull back, Netflix's leadership only strengthens. Many rivals are scaling back their streaming ambitions or struggling to turn a profit, while Netflix continues to expand its lead and set the pace for the industry. They're also exploring new frontiers, like gaming and live events, to boost engagement and diversify revenue. By experimenting with interactive content, mobile games, and even live sports or comedy specials, Netflix is constantly evolving to keep its audience entertained and engaged. Financials are strong, accelerating revenue, expanding margins, and billions in free cash flow. Netflix's ability to generate consistent profits while investing in growth is a testament to its operational excellence and disciplined management. Netflix is paying down debt and buying back shares, signaling confidence in their future. These moves reward shareholders and show that management believes in the company's long-term prospects. The stock isn't as cheap as before, but its dominance and growth prospects make it a compelling buy. Investors looking for a leader in digital entertainment with a proven track record should keep Netflix on their radar. Netflix's culture of innovation, led by experienced management, keeps them ahead of the curve. The company is known for its willingness to experiment, take risks, and quickly adapt to changing trends, which has been key to its sustained success. This isn't a speculative bet, it's an investment in a proven market leader with a clear path to more growth. Netflix's track record of execution and innovation makes it a cornerstone holding for any growth-focused portfolio. Their moat is brand, scale, and content library. Netflix is the default entertainment app worldwide. For many, it's the first place to look for something new to watch, and its vast library ensures there's always something for everyone. With a market cap of $503.17 billion, Netflix posted $39 billion in revenue for 2024 and brought in $8.71 billion in net income. That breaks down to $24 in earnings per share and a P/E ratio of 49.19, which reflects the market's high expectations for continued subscriber growth and content dominance. Despite competition from every angle, Netflix continues to innovate, retain global subscribers, and monetize its content in smart, strategic ways, keeping investors bullish about its long-term potential. For investors, Netflix offers a rare blend of growth, profitability, and resilience. Its ability to weather industry shifts and economic cycles makes it a standout in the tech and media landscape. They've weathered the streaming wars and emerged stronger than ever. While others have faltered or merged, Netflix has only grown more influential, setting the standard for what streaming can achieve. That's why Netflix is our third and final must-own growth stock. Its combination of innovation, scale, and financial strength makes it a top pick for the future. The future of entertainment is streaming, and Netflix is still leading the way. As technology and tastes evolve, Netflix's commitment to quality, accessibility, and innovation ensures it will remain at the forefront of the industry for years to come. There you have it, Meta, TSMC, and Netflix, three powerhouses shaping the future and offering long-term growth. These three companies represent different but powerful areas of tech growth: social platforms and AI, semiconductors, and streaming content. Together, they offer a fascinating look at where the next wave of digital dominance might come from. These aren't just trades, they're foundational investments for building lasting wealth. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. For exclusive tips and real-time alerts, join the StocksGalore Patreon community. Now your turn. Which of these three stocks are you most bullish on for the next 5 years? Drop your answer in the comments. Like, share, and subscribe for more investing insights. Thanks for watching. See you in the next one.